Yes, it's a real place. A remote Japanese village where there are now more scarecrows than actual people, because most had either moved away or quietly passed on. He stood there, looking at those life-sized scarecrows, and asked himself, "Do I really want to spend my best years grinding away, only to end up like this?" That solo drive across Japan changed everything. And honestly, it might just change the way you think about money, time, and life. So stick around till the end, because this isn't just another fire story. It's a real Singaporean YouTuber's plan to hit $4.5 million by 50, using both U.S. growth stocks and dividend investing strategies you can apply too. Like this video so more Singaporeans get to see this message. And of course, subscribe to Wealth for You to keep learning how to invest smarter, live better, and buy back your time. Disclaimer: this video is for education, not financial advice. Please do your own research before investing. Please note that you can easily find the Singaporean YouTuber just by doing a search, as I would not list the channel here. All information listed here are extracted from his YouTube channel. Chapter 1. His new life goal after Japan. After that solo drive across Japan, through quiet villages, lonely roads, and finally Scarecrow Village, he came home with a clear decision. I want to retire by 50. Not because I hate my job, but because I want the freedom to live life on my terms. For him, that freedom means simple joys, traveling with his family a few times a year, enjoying good meals without checking prices, and finally ticking off a bucket list dream, visiting all 47 prefectures of Japan while learning the language. But to do all that without money stress? He knew he needed a plan. So he set a bold target: grow his portfolio from $410,000 to $4.5 million in just 12 years. That's enough to generate $15,000 per month in passive income using the 4% rule. Not flashy billionaire money, but enough to live comfortably, intentionally, and with zero financial anxiety. Not rich, just rich in time, rich in options, and rich in peace of mind. Chapter 2. His investment journey. So, how exactly is he planning to turn $410,000 into $4.5 million? Like many of us, he started with the QQQ ETF, a popular fund that tracks the NASDAQ 100, filled with big-name tech giants like Apple, Microsoft, and Nvidia. It's diversified, convenient, and has done well historically, returning around 12% a year over the long term. But after crunching the numbers, he had a sobering realization. 12% is good, but not good enough for me to hit $4.5 million in 12 years. To reach his goal, he needed an average return of 16.5% per year, which meant he had to go beyond passive ETFs. So he made a bold move. He sold off his QQQ and began picking individual U.S. growth stocks, but not randomly. He focused on companies he actually understands from his own experience working in tech. Think e-commerce platforms, cloud providers, and AI-related businesses. These weren't just hype plays. They were deep research picks, aligned with long-term tailwinds and business models he could explain over copy. Instead of investing in everything, he invested in what he knew. Chapter 3. His investment principles. A simple, focused game plan. Over time, he developed a set of investing rules that kept things clear and manageable, especially while juggling a full-time tech job. First, he made it a rule to only invest in what he understands. Since he works in tech, that became his sandbox. He doesn't pretend to know everything, but in the world of cloud computing, e-commerce, and AI, he speaks the language. That's his edge. Next, he chose to keep his portfolio small and concentrated, under 10 stocks. Not because diversification is bad, but because depth matters more than breadth. He wants to know every company inside out, not vaguely hold 50 names he can't explain over copy. He also looks for companies riding on strong tailwinds. Powerful trends like artificial intelligence, cloud infrastructure, and online consumer behavior. Things that aren't just hot right now, but are likely to keep growing over the next decade. Then comes his discipline. Never chase, only buy when it's undervalued. He uses tools like Guru Focus to assess intrinsic value and waits patiently, even if it means sitting on cash for months. He's not in a rush. He's in it for the long game. And finally, he leaves space in his portfolio for moonshots, those bold, speculative bets with the potential to explode. Think Amazon's in-house chips or Apple's upcoming AR glasses. They're small bets, but if they take off, they can make a huge difference. Simple, intentional, and built around his strengths, not hype. Chapter 4. His life philosophy, living simply so he can live freely. Outside of investing, his lifestyle might surprise you. He lives in a humble BTO flat, not some flashy condo with rooftop BBQ pits and gym no one uses. He doesn't drive a car, because let's face it, COE in Singapore is basically daylight robbery. And he doesn't care for branded goods. No LV bags, no Gucci slides, no Rolex peeking out of his sleeve. Why? Because for him, it's not about flexing wealth, it's about building freedom. Every dollar he doesn't spend on showing off is a dollar that goes straight into buying his future time. He practices delayed gratification like a pro, choosing satisfaction later over spending now. No chasing the latest TikTok lifestyle of upgrade to condo, drive BMW, and pop champagne on the balcony. He's not playing that game. He's playing a longer game, the one where he retires at 50, travels freely, and never worries about money again. To him, that's the real flex. Chapter 5. His retirement plan. 2 ways to cash out without stress. Once he hits age 50 and hits his $4.5 million target, he's got 2 options, and both are designed to give him freedom without financial stress. Option 1. Switch to local dividend stocks. He could sell off his U.S. growth stocks and move everything into reliable Singapore dividend stocks, like DBS, UOB, OCBC, and some stable REITs. These typically give 4 to 5% annual dividend yield, meaning he can just collect the dividends every year, around $180,000 per year or $15,000 per month, not touch the capital, and enjoy a low volatility, tax-free, forex risk-free cash flow. All in SGD. It's chill, predictable, and doesn't require him to check stock prices every week. Option 2. Stick with his U.S. growth portfolio. The other route. Just keep his growth stocks and withdraw 4% a year by selling shares gradually. This method potentially gives higher long-term returns, especially if tech continues to boom, but comes with more volatility and requires some emotional resilience, because selling during a market dip is never fun. He'll need to be more hands-on, sell more in good years and less in bad years, kind of like managing your own paycheck from your portfolio. In his own words, honestly, it depends on how sharp and motivated I still feel at 50. If I still enjoy researching tech stocks, I'll stick to the growth strategy. But if I just want to relax, read a book, eat ramen, and travel Japan with my family, then dividend stocks, here I come. Chapter 6. So, what's the best method for us? Now here's where I'd like to chime in with my 2 cents. The Singaporean YouTuber took the high-risk, high-reward path: stock picking, deep tech research, concentrated portfolio. And to be fair, it's working. He's seeing about 15.7% returns a year, which is impressive by any standard. But let's be real. Not all of us want to spend our evenings reading 10K filings or decoding AI chip trends after work, especially if you're in your 30s, juggling your career, maybe thinking about kids or a home. You might not want another part-time job monitoring stocks. That's where dividend investing really shines. Chapter 7. Why start with dividend income even in your 30s. Here's what makes it powerful. First, predictable cash flow. You get paid real Singapore dollars every quarter, even when the market is down. Second, lower stress. There's no need to time your exits or worry about when to sell. Third, it's tax-free in Singapore. No dividend tax here, unlike in the US. Fourth, there's no forex risk. You're paid in Singapore dollars, not US dollars, so your spending power is protected. Fifth, it's passive by nature, with a basket of blue-chip dividend stocks like DBS, OCBC, and UOB, or blue-chip REITs like CICT, you can mostly sit back and just reinvest your payouts. Sixth, the compounding magic. Reinvested dividends grow your income over time, and that snowball can get really huge by your 50s. You may not hit 16% CAGR like the Singaporean YouTuber, but honestly, you don't need to. Even a 4 to 6% yield, compounded steadily over 15 to 20 years, can get you to financial freedom, with way less effort, and a lot more peace of mind. In other words, you don't need to be a market genius to build cash flow. You just need to start early and stay consistent. So if you're 30-something now, don't wait. Start building your Singapore dollar income machine today, and the future you will be very, very thankful. Chapter 8. Growth versus Dividend. Which is better for you? Let's break it down honestly. If you're someone who has the time and energy to actively monitor markets, has a higher risk tolerance, and maybe even works in tech or finance, then sure, growth investing through individual stocks might get you to your financial goals faster, especially if you have a strong circle of competence like the Singaporean YouTuber. But here's the thing, most people don't have that combo, and that's totally okay. If you prefer peace of mind, want your investments to generate reliable SGD income, and would rather spend time with your family than reading earnings reports, then dividend investing is your best friend. Chapter 9. Dividend investing works at every age. A lot of people think dividends are only for retirees. That's not true. Dividend investing works at any age. In your 20s? You get a long runway. Reinvest every payout and let compounding do its quiet magic over decades. In your 30s or 40s, it becomes a second income stream, growing steadily in the background while you focus on your career or family. In your 50s or 60s, that portfolio you built earlier can now pay you consistently. No need to touch your capital or worry about market swings. And if you start in your 50s, that's still not too late. You can still build cash flow, especially with high-yield REITs such as Fraser Centrepoint and dividend blue chips such as DBS, OCBC, and UOB. Chapter 10. Why dividend income makes sense in Singapore. Let's face it, living in Singapore isn't cheap. From kopi that costs $2.50 to condos that feel like the price of a small island, every little bit of stable income matters. That's where dividend investing comes in. And in Singapore, it's especially sweet. First off, there's no dividend tax here. What your portfolio pays out, you keep 100% of it. No cuts, no hidden charges. Just pure passive income flowing in every quarter. Second, you're earning in SGD and spending in SGD. No USD conversion headaches. No worrying if the exchange rate will make in your returns. What you see is what you spend. And that peace of mind? Priceless. Then there's the big one. No estate tax complications. Unlike US stocks, where your heirs might get hit with a hefty estate tax, Singapore-listed dividend stocks and REITs come with no such baggage. Clean, simple, straightforward. And the best part? You don't need to sell anything. Even during market dips, your dividends still arrive, like clockwork. You're not forced to liquidate at a loss. Your income stream keeps flowing, rain or shine. So, which strategy fits you better? If you love diving deep into companies, following the latest tech trends, and don't mind some roller coaster moments, growth investing might be your jam. But if you're someone who wants a simple plan you can stick to, reliable income in your own currency, and the freedom to live life without watching the stock market like a hawk, then dividend investing is your quiet power move, especially in Singapore, where the system is built to reward it. And hey, as they say, the best time to plant a dividend tree was 10 years ago. The second best time? Today. Whether you go the Singaporean YouTuber way or the slow and steady dividend way, start now. Because the biggest risk is waiting too long and ending up with no time left to enjoy. Final thoughts. So yes, the scarecrows in that quiet Japanese village were just dolls. But to this Singaporean investor, they were a wake-up call. A reminder that life can pass us by while we're too busy chasing the wrong things. Let's not become scarecrows in our own lives, stuck in the same place, too late to chase the life we really wanted. If you're ready to start building cash flow, freedom, and a future you actually control, give this video a like so more Singaporeans can discover it. Subscribe to Wealth for You and hit the bell so you don't miss our next episode on investing and financial freedom. See you in the next video. And until then, keep building a life you won't need to escape from.